Welcome to the Forever Cash Life Real Estate Investing Podcast with your hosts, Jack and Michelle Bosch. Together, let's uncover the secrets to building true wealth through real estate and living a purpose-driven life.
Hello everyone, Jack Bosch here, and welcome to another episode of our Winning Wednesday or Forever Cash real estate investing podcast, depending on where you watch this. So today I will cover the subject of how does land compare to other real estate investment methods, right? How does land compare to for example, to house flipping, to Airbnb, to you name it, to the different kind of pieces out there. So if you're interested in that, give me a heck yes here. Comment on there. What's your experience in this? So first of all, let's talk about what is land flipping. I mean, you know what land flipping is. If you have been following us for a while, if you're in our Facebook group, the Land Profit Real Estate Investing Group, or if you joined right now for our upcoming masterclass, go to landprofitmaster.com and register for our upcoming free 5-day plus a couple of bonus days masterclass, right? So make sure you go over there, register right now because it's absolutely free, right? So today's session is how does land compare to other methods? Well, let's go to some number examples here, guys. So let's look at it. Land flipping is what we do is we basically put a piece of land on a contract from a seller that no longer wants it, and then we turn around and we sell that property quickly with a markup, but usually below market value, and we make a bunch of money in the process, right? It's really that simple. So you take a $100,000 property, put it under contract for $30,000, sell it for $65,000, make it to a $35,000 profit in the middle without touching the land, without seeing the land, without changing the land, without improving the land. Heck, you do it in a way that you don't even need to use your own money. So now how does that compare to other real estate investing? Well, let's say you have $200,000, right? That's your nest egg. You say like, you know what? I want to get into real estate and I have 200 grand. So let's say you want to get into rental properties. Okay. So you get a rental property and you have 200 grand, and let's say in your market, rental properties cost $300,000. So you need to put down 20% on these loans, and therefore you put down $60,000 per house. You have enough money for 3 houses and some closing costs and a little bit of repairs and things like that, $20,000 just for like minor cosmetic things. So you can buy 3 rental houses, and in these rental houses, now you put $60,000 down, you have a $300,000 house, you have a $240,000 mortgage, which right now at the interest rates is probably going to be, including property taxes and a little things like that, it's going to be about, let's say, $1,100, so $1,200 mortgage. So let's say these houses now rent for $1,800. So you're making $600 on that house. Minus of a little bit what we usually do in rental houses, you need to have a little bit of an allowance for repairs, things like that. You have to have a little bit of allowance for vacancies. Let's say if the average tenant stays for 2 years, they move out, it's going to take you a couple $3,000 to bring the house back into what's called rent-ready condition, and obviously you lose $1,900 in rent for a month, but you still have to pay. So it might cost you about $4,000 every 2 years in lost rent, in mortgage that you have to pay, and in repairs to bring that house, make that house rent ready again. And then depending if you use a realtor or so, or a property management company, they often charge a fee for getting a new tenant in. So let's say like about $4,800 over 2 years, that's $200 a month that you have to allow for that. And $100, let's say, for overall kind of maintenance, repairs, $300. So you're renting this property for, let's say, $2,000. A mortgage is $1,200. You have an $800 after subtracting that. You're making $500 net cash flow on that house. Okay. So now basically times 3, you're making $1,500 a month or $18,000 a year on a $200,000 investment. So when you do that, that means your return on investment in this case is about 9%. So 9% per year, plus of course you're getting some depreciation from the properties because there's a write-off for it. You also pay down the mortgage a little bit. So if you add this all in, you might end up at about a 15% return on your investment to those rental houses. Okay, fantastic. Great. That's not bad, right? That's not bad, right? It's not bad. So you have that, and over the next 30 years, those mortgages pay themselves off because the tenants pays it off and so on and so forth. So that's all wonderful and that's all good. Okay, so 15% per year return. Great. So let's compare that now to, let's say, an Airbnb. So let's say you do an Airbnb and you basically do $200,000. Again, you take those houses, make them Airbnbs, but now you can only afford probably 2 of these houses because you need to furnish the houses. You need to probably make them a little prettier because Airbnb is going through a transition right now. People don't want to stay in crap places. Let's say these houses rent for $150, $200 a night and they rent for 200 nights a year. It's about 60%, 70% occupancy. So 200 nights a year times 200 is therefore $40,000 a year in revenue. Great. So now these houses make $80,000 a year in revenue. Again, the mortgages on these houses are the same. They're about, all included, about $1,500 in expenses and things like that, because if you have, now you're running basically a hotel with 2 units, right? Because constantly there's turnover and things like that. There's stuff that needs to be fixed. So now at the end of the day, therefore, let's say it's $1,500, $18,000, let's say $20,000 a house that costs you in property management and things like that. Well, it costs you in the mortgage, costs you with some repairs, like some furniture breaks, some things like that. So it costs you $20,000 a house per year to pay all the overhead for it. And then when you rent it, you're making $40,000. But if you don't want to become the hotel owner and be on the phone all day long and answer questions and inquiries and open doors and things like that, you're going to hire an Airbnb property management company for that. And the Airbnb property management company is going to charge you typically about 25% of that. So if the $40,000 each house makes, $10,000 go to them. So you're making 30, you're spending $20,000 a year, you're making $10,000 a year on each of these houses. Great. Now you're making $20,000 over 2 houses. You're making $20,000 a year in income, right? And if you over time get better, that can even go up higher, perhaps $25,000 or $30,000 a year in income. Wonderful. So now how much have you invested? Well, you've invested close to $200,000 and you're making $20,000 to $30,000 a year in income. Guess what? That's again about a 15%. But again, plus depreciation, plus mortgage pay down, you're probably going to be more perhaps in the 25 to 30% return on your investment. Hey, that's fantastic, right? You can invest in that and get a 25, 30% return on investment. Fantastic. So now let's look at land flipping. Let's look at house flipping. In house flipping, let's say you have $200,000 and you want to do a fix and flip. So here's what you do, right? You go and let's say you pick that, again, the houses in the neighborhood cost $300,000. First of all, you got to spend a lot of money on marketing. Let's say you spend $10,000 on marketing or $15,000 on marketing to get that one house. So then you go, you need to learn how to be the master negotiator. You become a master negotiator. So you now go and you meet with the people in the kitchen and you use all those NLP and psychological tricks and things like that to get that person to give you that house for $150,000. Great, right? So you help the person. Perhaps they were having a real issue or something, and they needed to get out of the house. So get their $150,000, pay off their mortgage, walk away with whatever equity they have left. And now you go, and now you need to find contractors. You need to rehab that thing. Let's say that might cost you $50,000 to rehab it. Right? Let's say $70,000 to rehab it. Because you get it that cheap, it probably was in really bad condition. So it's going to cost you $70,000 to rehab that thing. However, so the total in that you have on this property is $220,000. Well, so if you have $200,000, great. You can afford it mostly with your own cash. Right? Mostly with your own cash, but if you spend $15,000 or $15,000 on just getting the deal, and then you have to be in 220, you are still short a little bit, so you need some loan. You need a hard money loan for some money. That's going to cost you money. And then there's probably going to cost overrun. So instead of costing 70, it's going to cost you 80 or 90 to fix that house. So you basically overall expenses is going to be probably like the purchase price plus about you have to pay the realtor on the way out and things like that. So it's probably going to cost you like $100,000. So you're spending $250,000. So you have to get a loan for $50,000, and then you're selling the thing at $300,000, and therefore you're making net perhaps $50,000 on that deal. Well, that is great. But you now just spend half a year because probably particularly as a beginning investor, it's going to take you a while to find the deal. It's going to take you a while to find the crew. It's going to take you a while to fix the property. It's going to take you a while to sell the property. So it's easily like 6 months are gone and half a year is gone. and then you make $50,000 on that deal. Great. So now let's look at the return on that investment. The return on that investment is you put in $200,000 and you got basically your 200 back plus $50,000 in profits. Again, a 25% return on investment. Great, right? It works. There's nothing wrong with these kind of method. It's just, if you notice, there's all of a sudden there's a lot of work involved, a lot of different moving factors here, plus the crew and the overruns and the hundreds of runs to dozens of runs up to Home Depot, etc., etc., etc. So now let's compare this to land flipping. So in the land flipping, our typical investor, our typical student gets a deal for every about 700 or 800 letters that they send out. So therefore, you don't spend $10,000 or $15,000 in marketing. You spend about $600 in marketing, or $500. So you spend $500 in marketing, you get a deal, right? Once you've gone through a little bit testing period, but let's say on average you get a deal for every 700 or 800 letters you send out. So you spend about $500, $600 to get a deal. Well, so you get a deal. So therefore, if you have $200,000 to start out with, you don't even need all the money to get your deals. Number one. So let's say you spend like $5,000 or $3,000 or something like that in marketing, and you end up getting 5 deals. Now let's say each of these deals are like $80,000 value properties. So with our method, you put these properties under contract for about 10 to 40 cents on the dollar. So if they 80% of $80,000, you probably pay like about $25,000 for those. So let's say you actually use your cash and buy them, which, by the way, you actually don't have to in this scenario. You don't have to buy the properties at all. You can flip them without using your money and use that money instead for education and mastery in systems and things like that. But still, let's just say you're buying these properties for $25,000 each. So now you're out $100,000. You're not even out the $200,000 yet. So you technically could do 8 such deals with the $200,000. So let's say you do 8 such deals with $200,000, each of them for $25K. We don't repair the properties. We don't fix up the properties. We don't even go visit the properties. We don't see the properties. We have no travel costs. We have no crews. We have no repairs. We have none of those things. We don't have tenants, etc., etc. We have none of that going on at all. So therefore, there's really no other carrying costs. You own these properties. You own 8 properties at $24,000, $25,000 a piece, free and clear. And now they're worth $80,000 a piece. So 80 times 8, they're worth $640,000. So you have bought $640,000 worth of property for $200,000, and now you go and market them up. About 65% of market value is about where you can expect to sell them typically really quickly. So what is 65%? It's about 2/3 of the 80. Well, I should have picked a different number because that's harder to calculate. So let me quickly say $80,000 times 65% is $52,000. So $52,000 is the deal. So you're now making $27,000 a pop. Now, if we subtract from that a couple of closing costs, perhaps $2,000 a deal, you're making $25,000 a deal. So in every one of these deals, you're doubling your money. So in other words, now you're taking the $200,000 and sell these properties for over $400,000, and your net that you get back is $400,000. So you doubled your money, and you get a 100% return of your investment. And by the way, if you do that all in a matter of, let's say, the first 6 months, you do that a second time, now you actually have created a 200% return on your investment, right? Or what if you sell these properties, some of them, what if you sell 4 of them? Here's another way that you can skin this cat. What if you sell 4 of them for cash? Is four of them you sell for $55,000 each, right? So 4 times 55 is $220,000. So you have your $200,000 now back in your pocket, but you still own another 4 properties. And these 4 properties you now sell at $75,000, so very close to market value, with, let's say, a 20% down payment with $15,000 down. So you get on 4 deals another 4 times $15,000, which is another $60,000 cash profit in your pocket. And on these properties, you have a loan, you carry the note, right? You allow them to pay off the remaining $60,000 on these properties over the next 15 years at a 15% interest rate with about, I don't know, $600-700 a month in cash flow. So what you basically create is you get all your money back. You put $60,000 extra in your pocket, and let's say if each of these loans is $700, 700 times 4 is $2,800 in cash flow for the next 15 years. And each of these $60,000 loan with interest over 15 years actually pays out more like at $120,000 a piece. So you're basically making another almost $500,000 in profits just from the monthly payment and the interest and the pay down of those notes. So your total return on investment when you do this with land flipping is actually not just 100%, but it's more like 300 or 400% return on investment if you do this the right way. Now also, let's compare it to the Airbnb or the rental properties. In those you got cash flow, but with the model that we just did, where you were able to buy 8 properties for $25,000 each, sell 4 of them for cash and get all your money back plus some profits, and then take the other 4 and sell them with seller financing, which you basically have no money in them, get a 20% down payment, ask for a nice high payment with a nice high interest rate for a nice long time. You actually create more cash flow here than you created in either the Airbnb and the rental properties. And you're doing that with actually no money in the deal, with no tenants, with no bookings, with no having to deal with broken furniture and having to deal with broken toilets and having to deal with all this kind of things. And instead, you're getting like even higher cash flow and absolutely ridiculous 3 to 4-fold returns. Who is excited about that? Does that sound interesting to you guys? Well, if it is, then what I actually want you to do, guys, this is the kind of stuff we talk about in our upcoming land flipping masterclass. So just go over to landprofitmaster.com, register for the masterclass. It starts on March 21st. So if you listen to that as a podcast and perhaps March 21st has started already, it doesn't matter. Still go over there, right? There's going to be recordings up there for a limited period of time. You can reach out to our team also, and they can give you access to those. But make sure you jump in. And if you listen to this on time, if you listen to this live particularly, go to landprofitmaster.com and register for that event. So we're super excited. We have some really good strategies lined up for you. But can you guys see that with rental properties, you make a 15% return, and that includes depreciation and loan pay down. So your cash flow is only like 8%. With Airbnbs, you might get a 15-20% cash flow, or perhaps if you're really good, perhaps even higher. So you're getting like a 20-30% return on investment. With fix and flip, you might end up getting a 25-30% return on your money, right? But it's a lot of work. And with land flipping, it's much less work. It's much easier scalable, and you can literally get 300, 400, or 500% returns on your investment with all your money back after just a few sales and cash flow that is way bigger than any of the other methods, all in one method. Can you guys start seeing how land flipping is actually the superior method? And that's what we're talking about in the upcoming Land Profit Masterclass or Land Flipping Masterclass. Go to www.landprofitmaster.com and register right now. By the way, this is not being held in the same Facebook group that we held the past ones. It's held in a different Facebook group, and we're doing some Zoom calls too, right? So if you're not on Facebook, if you're listening to this as a podcast, still register, and then reach out to one of our land experts. They can guide you, and they can make sure that you can attend this session whether you're on Facebook or not. And obviously, if you're on Facebook, make sure you register and you join the Facebook group. It's a different Facebook group that we set up just for this masterclass. All right, with that said, see you guys next week. See you guys on March 21st. Super excited. See you there. Bye-bye.